Good afternoon, everyone. I'm Jordan Thomson with Citywide Mortgage Services. Today, I would like to speak about different terms that you may hear mortgage brokers use, or perhaps lenders, or you're reading about them and you're not quite sure what they mean, but you think you know what they mean. So I'd like to demystify those for you today. My daughter was asking me the other day as we were doing up a budget for school. She asked, Mom, what does equity mean? What are gross taxes, net taxes, liabilities, assets? And we all use these terms, but are we really sure we know what we mean? So the first term I'd like to talk about is qualification. Your qualification amount is the amount of mortgage that you qualify for based on your income, your down payment, and the current rates. So it's important for a broker like myself to actually take a look at your income documents and your down payment so that we can accurately determine how much you qualify for. The next is a pre-approval. So a lot of people think that a pre-approval is the same as an approval. It is not. It is exactly as it suggests. It is pre-approval. So essentially it is a rate hold. When we submit an application for your pre-approval, the lender will guarantee that particular interest rate for a period of time, typically 90 to 120 days. And they may or may not have actually looked at any income verification documents at that point. So really, it's just a pre-approval. It's not until approval that we actually start supplying those documents and, of course, obviously the property documents as well, because the lender must approve the property as well. Another thing is the term versus amortization. So a term of a mortgage is the length of time that you are committed to a particular interest rate, a particular lender, and the conditions set out by that lender. Typically, they are 6 months to 10 years long. And amortization is the length of time that it's going to take you to pay off your entire mortgage. And that can be 15 years to 25 years, 30 years, or even up to 35 years now. The next is IRD penalties. So you'll probably hear about this quite often. IRD stands for interest rate differential, and it's used for fixed rate mortgages. So if you choose to break your mortgage term, you will be charged the higher of 3 months interest or the interest rate differential. And it's a complicated formula that lenders use, so it's best to check what it is before breaking your mortgage, because it can be quite hefty. Finally, refinance. A refinance is not necessarily a renewal. A refinance is when you're going to change something about the mortgage. So perhaps you need more money, you'd like to do an equity takeout and draw on more money, or you'd like to extend the amortization. That is going to be considered a refinance. Sometimes it can happen upon renewal, which is when the end of your term comes up, but it is not the same. So I hope that helps in demystifying some of the mortgage terms that we use. We really don't want to use terms that our clients don't understand, so please don't be afraid to say, hey, can you please explain that to me, because it's really important that you know about your mortgage and what we're speaking of and what you're getting yourself into. So have a great Friday, have a great weekend. Thanks so much for watching, and I look forward to seeing you next week.